Hello everyone! Today, we're diving into the biggest story shaking global markets right now. The military clash between the United States and Iran, and what it means for stocks, oil, and your portfolio. This is not just another airstrike. After the joint US-Israeli strikes on Iran, reports emerged that Iran's supreme leader had been killed. The Middle East situation is escalating rapidly. President Trump stated, quote, 4 to 5 weeks, maybe longer, we will do whatever it takes, end quote. So, is this a short-term clash or the beginning of a prolonged conflict? Let's break this down. Part 1. The core of this crisis. There are 3 key elements. First, the symbolism. Eliminating Iran's supreme leader goes far beyond a military strike. It carries immense political symbolism. It simultaneously strengthens internal unity in Iran and provides justification for retaliation. Second, the Strait of Hormuz. A massive share of the world's seaborne crude oil passes through this narrow waterway. When Iran's Revolutionary Guard mentioned the possibility of a blockade, markets reacted instantly. Third, the energy supply shock. Saudi refinery disruptions, Qatar halting LNG export plant operations. This isn't just about oil prices going up. This is a structural risk that could send European natural gas prices soaring as well. Part 2. Oil and energy markets. Markets instinctively look at energy first. At the open, oil prices surged. Middle East risk leads to supply disruption fears, which leads to crude buying. But prices pulled back from their intraday highs. Why? Because a full blockade hasn't happened yet. The problem is that even the mere mention of a blockade is enough to move prices. If the Strait of Hormuz is actually blocked, we're not talking about a 5 to 10% rise. We could be looking at a structural surge in oil prices that's hard to reverse. That said, some experts believe the global economy can absorb a short-term, limited energy price spike. The real question is whether the supply shock becomes prolonged. That's the key variable. Part 3. The stock market reaction. Here's where it gets interesting. Stocks plunged at the open, then recovered most of their losses, and ended the day mixed. Why did that happen? First, defense stocks saw heavy buying. The bigger the war risk, the more investors expect defense companies to benefit. Second, energy stocks rallied. Rising oil prices are a tailwind for refiners and energy producers. Third, money rotated into large-cap tech stocks with strong balance sheets. But airline and travel stocks got crushed. Rising oil prices hit them like a freight train. So the market didn't collapse across the board. What we saw was sector differentiation. Part 4. What Trump's words really mean. Trump said, quote, "It doesn't matter how long it takes," end quote. What does this signal? First, this is not being treated as a short-term political event. Second, the hawkish stance will be maintained. Third, escalation remains on the table. For markets, the scariest thing is uncertainty. If the war ends within 1 to 2 weeks, the removal of uncertainty could actually trigger a market rally. But if it drags on, energy, inflation, interest rates, and growth, everything becomes interconnected. Part 5. Economic data and the Fed factor. On the same day, the February manufacturing index showed expansion, but input prices rose at their fastest pace since 2022. This is a critical signal because rising energy prices plus rising input costs equals renewed inflation fears. And if inflation reignites, expectations for Fed rate cuts go down. In other words, war risk isn't just a geopolitical issue. It feeds directly into monetary policy. Part 6. Experts are divided. One camp says macro fundamentals remain solid. Geopolitical tensions could actually be a buying opportunity. The other camp warns that blindly repeating the buy the dip after conflict playbook is dangerous this time around. Some also argue that markets had already been pricing in the possibility of military conflict for about a month before it happened. That means a significant portion of the adjustment may already be behind us. Part 7. What to watch going forward. The market's checklist is clear. Will the Strait of Hormuz actually be blocked? Where will oil prices stabilize? How severe will Iran's retaliation be? How long will the conflict last? And will the Fed change its tone? If the conflict doesn't escalate and oil stabilizes, markets can recover quickly. But if a blockade, wider war, or terror attacks become reality, expect elevated volatility for an extended period. Here's the bottom line. Right now, markets are in a zone where fear and calculation are operating simultaneously. Will you react to short-term headlines or read the structural shifts? The real key is two things: the duration of the war and energy prices. Whether this crisis turns out to be another buying opportunity or the start of a new era of volatility, we'll be watching closely. If you found today's episode helpful, please subscribe and share. See you in the next one.